So today I'm going to share something with you that I thought a lot of people actually knew about, but clearly when I was looking in yesterday's videos in the comment section and just in general people talk about the S&P 500, people are not aware what's going on inside the S&P 500 and the returns that the S&P 500 is currently doing that looks very impressive. There's some kind of hidden things that are going on in the background there, and I thought I'm going to share this with you guys today because it would be very useful for you guys to know this if you don't know it. So hope you enjoyed the video. If you could hit the like button, let's get started. So the S&P 500 is made up of the 500 largest companies listed in the United States. Now this has always been the benchmark to achieve that if you're stock market investing. If you are doing individual stock picking, the whole point is you beat the S&P 500. There's no point doing individual stock picking if you're not beating the S&P 500. You're putting all that time in, you're doing the research, you're taking all that risk. The point is that you achieve more than the S&P 500. If you're not doing that as an individual investor, well, you might as well save all your time and then just go buy the index. That's the whole point when you're doing individual stock picking. You might as well, the aim is to beat the S&P 500, which I think is a very good indicator to point to as a stock market investor. And you can see here with no research, if you bought the S&P 500 in the last 5 years, if you bought this time frame, you would have been up over 53% in the last 5 years. And if you look at the year to date, you would have been up 16.5% if you bought year to date. Now, this is actually where a lot of people don't realize what's going on in the S&P 500. So if you do look at year to date, you'd go 16% is the target to beat, which is obviously a really fantastic year when you consider the average return in the S&P 500 is around 8%. We've had a very good year in the S&P 500. But this is what a lot of people don't realize, and this is why at the moment it's getting a little bit of a difficult one to actually compare your returns to the S&P 500, because this return is slightly inflated because of a few individual stocks. So if you actually look at the S&P 500, you'd think, 500 companies, it'll be equal weighted. It's not. It's heavier allocation to the biggest market caps in the S&P 500. So for example, if you look at Apple actually makes up 7% of the whole index. One company makes up 7%. Microsoft, you've got another 6% there. Amazon, you've got another 3%. Nvidia, another 3%. Apple, you've got with the Class A shares, you've got 2%. Obviously, then you have the Class C shares, you've got Tesla, Berkshire Hathaway, Meta Platforms. So you can see it, a lot of these stocks make up a very good chunk of the portfolio, a lot of the weight in the portfolio. You've got nearly towards 20% of the weighting just there in those few companies. So this year, this data is taken from May the 30th, so just bearing that in mind, it is a couple months old, but it still is the right thing I'm trying to show you here. So if you look here, just 5 stocks, including Nvidia, account for 96% of the S&P's gains this year. And the reason why is because when you look at the $1 trillion club, which has Apple, Microsoft, Google, Alphabet and Amazon in, and obviously now Nvidia's gone on such a boom, it's now got Nvidia in. If you look at these companies alone, you've got Apple up 35%, Microsoft up 39%, Alphabet up 41%, Amazon up 43%, Nvidia up 176%. So these stocks in particular, because they have such a heavy weighting, they're dragging the S&P 500 up. If you actually take out the $1 trillion club of these stocks, you're talking where the S&P is actually flat for the year, or the other 495 cohorts in the 500 posted a combined gain of just 0.3%. So basically, if you take out these companies, the S&P is basically flat for the year. So it doesn't look as impressive. And this is what's happening. These couple of companies at the moment are actually covering up quite a poor performance in the S&P 500. So people are currently using this as a benchmark, but realistically, that benchmark, if you take out those 5 companies, has been pretty poor performing. You've got to have those few companies, or you're not doing that well. Same as if you're an individual stock picker. If you don't really have those companies in your portfolio, you're probably not doing that well, and that's one of the big issues that we have at the moment. And the reason why those companies are doing so well is because of the AI bubble that's going on. Now, it's controversial if you call it a bubble or they've just had a big boom because of the AI situation, but there is a point where it can only go up for so much. If it keeps going up and up and up, it is eventually going to end in an AI bubble. And when you look at those companies that are there that are really propping up the S&P 500, Nvidia, Amazon, Alphabet, Microsoft, Apple, how many times have you heard them say AI in their conference calls? They've said it nearly 50, 100 times in one conference call alone. So without doubt, these companies are doing so well because of this AI situation, and it's also making the S&P 500 look a lot better than what it is. So realistically, when you used to compare the S&P 500 as a benchmark, it's not really a good benchmark to compare to at the moment, because the returns look a bit better because of the only 5 companies that are in there. When you actually go out of that situation, when you take the AI bubble out, it's not that good. And especially when you look outside of, we talked about the other 495 stocks in the S&P 500, and that has put the S&P 500 up to quite rich valuations. You look here, there's only 2 times the S&P has been this highly valued on a forward price to earnings ratio. The other time was the 2021 bubble, which I'm sure most of you guys were in that stock market for that time frame. So many stocks got absolutely annihilated during that time frame. And the last time that I would say a lot of you guys weren't involved in, including myself, was the .com bubble. So the last time we saw valuations this high were in bubble scenarios. So it's a bit of a coincidence that all of a sudden the next time we're at these sort of valuations is to do with this whole AI situation. And that's the big thing, if we saw these 5 stocks have a big correction, you watch how quickly this S&P 500 would correct. If you just had Apple and Nvidia having a poor year, going down a couple of percentage, you'd see very quickly the S&P have a poor year. But what that also means is that actually when you look at the mid caps and small caps, and the mid caps are actually, because they don't have any kind of AI boom kind of going on here, they're currently valued at 13 times forward earnings. That is the 1, 2, 3, 4, about the 5th lowest it's ever been in the last 23 years, which shows you how low that's still valued because of the whole crash situation we went on in 2021. When you look at the small cap situation, and once again, they're trading at 13.3 forward times earnings, and there's only another 2 times the small caps. The small caps have been absolutely devastated. They're still being devastated. There's only 2 times they've ever been lower than where they are right now, and that's during the Great Recession in 08 and the CV crash that we had during that time frame. So the small caps are incredibly undervalued still compared to historical levels. Now, the big thing is that if you're an individual stock picker, you're not trying to buy the likes of the top 5 holdings in the S&P 500. You're not trying to buy Apple, Microsoft, Alphabet, Amazon, Nvidia. You're trying to pick, and those have really benefited from the AI situation. I think if it wasn't for the AI situation, it'd be very interesting to see where the S&P was at this year. But if you're an individual stock picker, you're trying to buy the best individual stocks, and sometimes it might be in the S&P 500, but a lot of them are going to be them kind of small caps and mid caps. And as you can see here, like these are still being annihilated. Now, don't get me wrong, there's a few that have started to recover a little bit, but there's still plenty out there that are still being devastated and still have plenty of to recover. And this is the thing, is that as an individual stock picker, you can't really compare yourself when you're still looking at the S&P 400 that's still at a historically low level. If you're buying any small caps, and you're still at the the 3rd lowest it's been since the 08 and the CV crash, it's very hard for you to compare that to the S&P 500 just because there's 5 stocks that are propping that up because they've had such a good rally because of the AI boom. And this is what I think is very key. It's very tough as an individual investor right now to be comparing your returns to an S&P 500 that's being propped up by a few individual stocks. So it's very important to put that into context right now, what's going on. And this actually leads me to 2 other points at the moment. So a lot of people are looking at it going, well, you see the small caps look attractive of value, the mid caps look attractive value. Why are people not buying them just yet? And why are people still putting money into the likes of Nvidia, Meta? People are still buying Meta at whatever it is, 300 something a share, when they could have bought it $80 only a few months ago. Why do people keep putting money on? Well, the thing is that hedge fund managers at the moment, if you're a hedge fund manager, what's your benchmark? Well, your benchmark is to get towards the S&P 500. So for them, if the S&P 500 keeps going up and the root causes of them stocks, they need to own the S&P. Well, they don't want to own the S&P 500, but they want to have obviously they can't say they're owning the S&P 500, but they want to hold mostly the stocks in the S&P 500 with a few tweaks. And that's why people, if those stocks are exploding on the gains, a lot of the hedge funds at the moment in Wall Street are putting the money into those stocks that are already very rich in valuation. Because otherwise, there's going to be questions at the end of the year. Why was the S&P up 16%, but you only achieved 2%? Well, that was in small caps and mid cap. Then that's not going to be acceptable. So that's why you have all that money still going into there, even though the prices are looking extremely overvalued. And like I said, you've seen it before. You know, if them levels keep going up and up and up, you know, as you saw in the .com, as you saw in the 2021 bull, eventually things will snap back to reality the more that goes up. And that's where you're at with the S&P 500. You're at a point where for a lot of these stocks that have boomed so much over the AI situation, either they can't keep going up how they are doing, they've either got a flat line or they've either got to have a big pullback. So for me, I look at that thinking I don't want to be heavily in that situation, because sooner rather than later your returns are going to be limited. So it does look at the moment that you want to be in probably those, you know, big stocks, but in the longer term there's only so long that they can keep getting dragged up on those valuations, then the other stocks can stay so low, which is worth pointing out. But the other point is as well is that what you've seen at the moment is, obviously we saw in 2021 so many stocks go down, and you probably see this on the YouTube scene as well, is a lot of investors at the moment are going, well, I just want to make sure that I'm somewhere around, and this is what a lot of hedge funds do as well. You know, like I said earlier, they obviously want to be buying those stocks so they can match the S&P's return. A lot of YouTube channels at the moment have gone, oh, I don't want to do individual stock picking. You know, last time I did that, small caps, mid caps are down so much and they've still not recovered, and then all these stocks are going up, and you know, I need to be saying that I've got all these stocks going up, so I need to just buy them stocks at ridiculous valuations. That's why you've seen a lot of YouTubers at the moment, they're building portfolios with Apple, Nvidia and Tesla all as their biggest holdings, so they can go, oh look, I'm up that much and I'm doing this, you know, compared to the S&P 500. And that's why a lot of them are buying that at the moment, and that's why you've got that momentum building so much on those stocks. But like I said, for me, I look at that and think it's a bit of it's not a good situation to be looking at, because the S&P's been propped up by them stocks and they keep going up and up, and their valuation stretched. It's at the highest it's ever been since the bubble of the .com bubble and also the 2021 bubble. It's so long, it's going to be so long until those stocks flatline, because they can't go any higher because the valuation's so rich, or they have a snap back to reality because the valuation's so stretched. And that's why at the moment you can't really, as an individual investor, it's a bit hard to compare to the S&P 500. You know, more than anything, as an individual investor, you want to be comparing to probably the S&P 400 or the S&P 600. That's a bit more of reality what's kind of going on there in the current environment at the moment. So I thought I'd just share that, because I think a few people don't realise how much the weighting of the S&P 500 is towards those companies, and also why the S&P looks so good this year, but actually when you look beneath it, it's not actually been that good of a year. So if you've outperformed this year without having a big heavy allocation into those tech stocks, if you're actually achieving 10, 20, 30%, you're doing absolutely amazing, because you look outside of those stocks, every other stock performance has been very low. You know, you're only talking 1-2% this year. So yeah, hope you enjoyed the video. That's also personally for me why I actually see so much more opportunity in the small caps and mid caps to the big tech at the moment, and that's why you probably don't see me buying Google anymore. It's why you don't see me buying Meta, Tesla, for example, Amazon. As much as I love Amazon, I still think it's a little bit of a rich valuation. Nvidia, for example. So yeah, that's also another context from that point of view, I guess, as well. So hope you enjoyed the video anyway on a Saturday, and if you could hit that like button if you're new, subscribe, and I'll see you on the next video.